Hi, class. Okay, so we're going to finish this week out talking about interest rates and bond valuation in chapter 6. In this chapter, we're going to be able to describe interest rate fundamentals, the term structure of interest rate, and risk premiums. We're going to review legal aspects of bond financing and that cost, and discuss the general features, the yields, prices, ratings, popular types, and international issues of corporate bonds, and understand key inputs and basic models used in the bond valuation process. We're also going to look at applying basic valuation models to bonds and describing the impact of required return and time to maturity on those bond prices. We're going to explain the yield to maturity, or YTM, its calculation, and the procedure used to value bonds that pay interest semi-annually. So when we look at, the interest rates and required returns, when we're looking at our fundamentals, our interest rates, those are usually applied to debt instruments like bank loans, bonds. Their compensation paid by the borrower of the funds to the lender. And from the borrower's point of view, the cost of borrowing funds to us. The interaction of supply and demand determines those interest rates. So a required return is the return that supplier of those funds requires the demander to pay. It applies to almost any kind of investment. So here's an example of supply-demand relationship. So again, the funds supplied over demanded is the bottom part of this graph, and then the equilibrium interest rate is on the left-hand side. So, for example, there is our demand sloping curve there. It's not really a curve, it's more of a line, but our demand line, and our supply line. So at S0, that equals D, our rate is at 0, or R0. When we have a higher amount of supply, we're going to move down the demand curve and hit a lower rate, if that makes sense. We could look at inflation as well. This is a rising trend in prices of most goods and services, and also liquidity preference. So a general tendency for investors to prefer those short-term or more liquid securities. We can also look at negative interest rates. When a loan carries an interest rate below 0, the lender essentially is now paying interest to the borrower rather than the other way around. So a natural question is, why would anyone want to buy an investment if it paid an interest rate below 0? The answer to that is that there's no good, safe alternative offering in a better return. When the coronavirus broke out in 2020, financial markets reacted in a dramatic fashion. On March 25th, interest rates on a 1-month and 3-month Treasury bills briefly turned negative, meaning that investors were paid more to the Treasury than the Treasury promised to pay back. So why would people put their money into an investment that they know will lose money? Fear about the effects of COVID-19 on the economy sent stock prices tumbling. Investors moved their money to safer securities. The demand for those securities was so high temporarily that investors effectively paid the U.S. Treasury to hold their funds for a short time. Nominal and real interest rates. With nominal rates, that's the actual rate of interest charged by the supplier of funds and paid by the demander. A real interest rate is the rate of return on an investment measured not in dollars, but in the increase in purchasing power that investment provides. So the real rate of interest measures the rate of increase of purchasing power. So for our equation here, nominal and real interest rate. So 1 plus R is equal to 1 plus R star times 1 plus I. So R is our nominal interest rate. R star is our real interest rate, and I is our expected inflation rate. So an example for this, Bert Gummer is a survivalist that constantly worries that the apocalypse might happen any day now. So to be prepared, Bert stores food with a long shelf life in his basement. Bert has $100 to add to his food stores, and he's considering the purchase of 100 cans of Spam for $1 each. He expects inflation over the next coming year to be 9%, so a can of Spam will cost $1.09 each in a year. Bert's wife, Heather, has heard the investment that will pay a 21% nominal return over the next year. So she thinks that Bert should invest the money rather than use it to buy Spam. So if we put those figures into the equation, 12% is about roughly 21 minus 9%. So on the basis of this calculation, Bert might expect that if he invests $100, he could buy 112 cans of Spam next year rather than 100 cans this year, which is a 12% increase in purchasing power. Suppose that Bert invests the money, earns a 21% rate of return, and 1 year later has $121. By that time, one can of Spam costs 109 or $1.09. So Bert is just barely able to purchase 111 cans. So 111 times $1.09 is 120.99. Bert's purchasing power has increased by 11%, not the 12% that he expected. So we revealed that the exact real return is 11%. So 1 plus 0.21 is equal to 1 plus R star times 1 plus 0.09. So we have to figure out what R star is. That's his real interest rate. So 1.21 divided by 1.09 equals 1 plus R star. 1.11 minus 1 is equal to 11%. We also have this equation here to look at the risk-free rate. So risk-free is equal to R star, which is our real rate of interest, plus I. We also can look at the nominal return on our investment by looking at the rate of the nominal return that's equal to our risk-free rate plus our risk premium above the risk-free rate for that investment. Here are the inflation rates and the risk-free rates over a 1-year Treasury bill rate and inflation from 1962 to 2019. Interest rates on a 1-year Treasury bill issued in January of each calendar year here. So we can see that the change in consumer price index in each calendar year has affected the interest rate of the Treasury bills. The interest rate is in blue, and then the Treasury rate is in red. So wherever you see a shaded blue, there's positive real interest rate, where that bill rate is higher than the inflation rate. Where there's negative real interest rate, that's where the red is, where that inflation rate was higher than the bill rate. As you can see over the past couple of years, it hasn't been the best. It's been in the negatives. We can look at term structures on those interest rates by looking at the yield curves. So the term structure is a relationship between the maturity and the rate of return for bonds with similar level of risk. A yield curve is a graphic depiction of that term structure. And a yield to maturity, or YTM, that's that compounded annual rate of return earned on debt security purchased on a given day and held to maturity. It's an estimate of the market's required return on that particular bond. With yield curves, we can see a normal yield curve. This is an upward sloping yield curve, indicating that long-term interest rates are generally higher than short-term ones. An inverted yield curve is a downward sloping yield curve, indicating short-term interest rates are generally higher than those long-term rates. And a flat yield curve is a yield curve that indicates that interest rates don't vary much at different maturities. So again, that's going to be a flat one. So here are the Treasury yield curves. We can see April 2020 was somewhat flat. Same with December of 06, July of 06. February 22 was more upward. With yield curves, there is deflation. That's the general trend of falling prices. So the shape of the yield curve may affect a firm's financing decisions. A manager is going to look at a downward sloping yield curve. They may tend to rely more heavily on cheaper long-term financing. If the curve is upward sloping, that manager might be saying, hey, we should use a cheaper short-term financing method. So here's the slope of the yield curve and the business cycle. This is over a 5-year Treasury bond yield and a year Treasury bill yield. On March 9th, 2020, again, COVID, the 10-year Treasury note yield reached an all-time low of 3.18% as fears about the spreading coronavirus and its impact on the economy prompted investors to pour money into safer securities with the Treasury. Lower interest rates are usually good news for the housing market. So many mortgage rates are linked to those rates on Treasury securities. So for example, the traditional 30-year mortgage rate is linked to the 10-year Treasury note. Mortgage rates did reach new lows, but the slowing economy discouraged those home buyers and sellers from taking advantage. Although a lot of homeowners did benefit from the falling rates when they refinanced their mortgages. So if we look at the term structure of those interest rates, we look at theories of that term structure. There's the expectations theory. This is going to say that the curve reflects investor expectations about future interest rates. An expectation of rising interest rates results in an upward sloping yield curve, and an expectation of declining rates result in that downward sloping yield curve. Suppose that 1 year T-bill currently offers a 3.5 return and a 2 year Treasury note offers a 3% annual return. So the short-term rate is higher than the long-term rate, and the yield curve slopes down. According to expectation theory, what belief have the investors held about the rate of return on that 1 year T-bill that it will offer next year? So what we need to do is first recognize that by purchasing the 2 year note, investors can earn a return of 6.09 over 2 years. And that's calculated by the 1 plus the rate over the multiplied by itself again for the 2 years, because it's to the second year exponent. So that's the 1.609. So subtract 1 and you get the rate. So 6.09. If the market were in an equilibrium, then the expected return on the strategy of purchasing a sequence of 2 1 year bills, T-bills, must offer the same return. So with that, we can plug that in to find out what our expected return is. So 1 plus 0.035 times 1 plus the expected rate equals 1.0609. So here what we're going to do is we're going to take that 1.0609, divide it by that 1.035, and we find that our expected return is 2.5%. So investors are going to believe that that T-bill will offer that 2.5% return next year, which is lower than the 3% return offered by that 1 year T-bill. So they're indifferent between earning 3% for 2 consecutive years on the Treasury note or earning 3.5% this year and 2.5% next year on the sequence of the 2 1 year bills. So the downward sloping yield curve implies that investors expect falling rates. Another theory is the liquidity preference theory. So this suggests that long-term rates are generally higher than short-term rates. So the yield curve is going to be upward sloping because investors are perceiving those short-term investments as more liquid, less risky than those long-term ones. Borrowers have to offer higher rates on long-term bonds to entice those investors away from their preferred short-term securities. The market segmentation theory suggests that markets for loans is segmented on the basis of maturity, and that the supply of and the demand for loans within each segment determines that prevailing interest rate. So the slope of the yield curve is determined by the general relationship between the prevailing rates in each market segment. We could look at return risk premiums, the issuer and issue characteristics. So the nominal rate of interest for security J is equal to the risk-free rate, consisting of the real rate of interest plus the expected inflation rate plus the risk premium. So the risk premium varies with characteristics of the company that issued the security, as well as characteristics of that security itself. So here's an example of the nominal interest rate on a number of classes of long-term securities in April of 2020. So 1 year U.S. Treasury bills, the nominal interest rate was 0.2%. In corporate bonds with investment grade, you're looking at 3%, and high yields were at 8%. Using the 1 year Treasury bill rate as our benchmark risk-free rate, we can calculate the risk premium of the other securities by subtracting that risk-free rate of 0.2% from the rates offered by the other corporate securities. So investment grade went down to 2.8%, and the high yield went down to 7.8%. So investment grade bonds pay a risk premium over the Treasury bills in part because of their term. Investment grade bonds usually have a longer term, but also because they're issued by corporations. They're not backed by full faith and credit of the U.S. government like securities, the Treasury bills. So high yield bonds pay an even larger risk premium because they're issued by less creditworthy corporations. Several factors influence a bond's risk premium. So we could look at the default risk or credit risk, where the corporation maybe will fail to make interest payments or principal repayments on those bonds. We could look at bond characteristics like time to maturity. We could look at interest rate risk, where the interest rates in the economy change, bond prices are moving in the opposite direction. Or maybe some bonds are more sensitive to interest rate risk and therefore have to pay higher risk premiums to compensate those investors. We could look at corporate and government bonds as well. So a municipal bond that's issued by the state or the local government body. A corporate bond is going to be long-term debt instrument indicating that the corporation has borrowed a certain amount of money and promises to repay it in the future under clearly defined terms. We could also look at par value, face value, and principal. This is the amount of money that the borrower has to repay at maturity and the value that the periodic interest payments are based on. The coupon rate is the percentage of a bond's par value that will be paid annually in two equal semi-annual payments as interest. There are legal aspects to corporate bonds. So there's bond indenture. So this is a legal document that specifies the rights of the bondholders and the duties of that issuing corporation. There are standard debt provisions. So these provisions in a bond indenture, they specify certain record keeping, general business practices that the issuer has to follow. They cannot place a burden on financially sound business. There are restrictive covenants. These are provisions on those bond indentures that place operating and financial constraints on the borrower. There could be subordination where the stipulation that subsequent creditors agree to wait until all claims of the senior debt are satisfied. Or there's a sinking fund retirement where this is a restrictive provision that's included in a bond indenture providing for systematic retirement of bonds prior to them maturing. Collateral is where a specific asset against which the bondholders have a claim in the event that the borrower defaults on their bond. A secure bond is backed by some form of collateral, where an unsecured is only backed by their ability to repay the debt. A trustee is a paid individual, corporation, or commercial bank trust department that acts as a third party to a bond indenture, and they can take on specific actions on behalf of the bondholders if the terms of the indenture are violated. We could look at the costs of bonds to the issuer. So we look at the impact of that bond's maturity. So usually long-term debt pays higher interest rates than the short-term debt. We could look at the impact of the offering size. So bond flotation and administrative costs per dollar borrowed are likely to decrease as offering sizes increase. However, the risk to the bondholders might increase because larger offerings result in a greater risk of default. And then we could also look at the impact of the issuer's risk, where the greater the risk, the higher the interest rate. We could also look at the impact of the risk-free rate. So the risk-free rate in the capital market determines the floor on the cost of that offering. So generally on the U.S. Treasury securities of equal maturity is the lowest cost of borrowing money. So to that basic rate is added a risk premium that reflects the factors mentioned prior, like maturity, offering size, and issuer's risk. There are different features to a bond's issue. We have a conversion feature that allows the bondholders to change the bond into a stated number of shares or common stock. There's a call feature that's included in normally all corporate bonds that give the issuer the opportunity to repurchase those bonds prior to maturing at a certain price. It's called a call price. Again, so that's the bond can be repurchased at that specific price prior to maturing. The call premium, that's the amount by which the call price exceeds the par value or the initial purchase price. The stock purchase warrants, those are instruments that give the holders the right to purchase a certain number of shares of the issuer's common stock at a specified price over a certain period of time. We can look at bond yields. The current yield is the measure of a bond's cash return for the year. It's calculated by dividing the annual interest payment by the current price. So we can look at yield to maturity and then yield to call as well. Corporate bonds are held mostly by institutional investors. They're not actively traded as stocks, but it's still important to understand the market conventions for quoting those prices and yields. So with that, there are basis points. That's a way of quoting an interest rate such that 100 basis points equals 1 percentage rate. So here's some data on some selected bonds. You see Verizon, Apple, Tesla, Safeway, and Amazon. The coupon percentage rate, the maturity rate date, the price, and the current yield to maturity. Bond ratings. Those are independent agents like Moody's, Fitch, and Standard and Poor's. They assess that riskiness of those publicly traded bond issues. They derive the ratings by using financial ratios, cash flow analysis to assess the likelihood that that bond payment is going to be paid, both interest and principal. So usually an inverse relationship between the quality of the bond and the rate of return exists. And that's got to be provided to the bondholders. So here is an example of Moody's and Standard and Poor's bond ratings. Some ratings might be modified to show relative standings within the major category. For example, Moody's uses numerical code modifiers like 1, 2, 3, where Standard and Poor's uses plus and minus signs. There are different common types of bonds. There are debentures, subordinated debentures, income bonds, mortgage bonds, collateral trust bonds, equipment trust certificates, zero or low coupon bonds, junk or high yield bonds, floating rate bonds, extendable notes, and putable bonds. So here are some characteristics and priority of a lender's claim of traditional types of bonds. So this is all listed in your textbook. So like with debentures, those are usually unsecured that only creditworthy firms can issue. Usually convertible bonds are debentures. So with the lender's claim, they are usually the same. They might have other unsecured bonds subordinated to them. And again, it goes through listing like the mortgage bonds. Those are secured by real estate or buildings. So the priority of the lender's claim is on proceeds from the sale of those mortgage assets. If it's not fully satisfied, they become a creditor. The first mortgage claim has to be satisfied before any proceeds are distributed, second mortgage holders, and so on. Number of mortgages can be issued against the same collateral. Collateral trust bonds, those are secured by bonds or stock that are owned by the issuer. Equipment trust certificates, those are used to finance rolling stock like airplanes, trucks, boats, railroads, cars. There are zero bonds. They have no or very low coupon, which is a stated interest rate. Junk high yield bonds, those are usually debt rated BA or lower by Moody's or BB or lower by Standard and Poor's. The floating rate bonds, usually they are adjusted periodically with those interest rates. Extendable notes are short maturities, usually 1 to 5 years. Putable bonds, they can only be redeemed at par. They're usually typically 1,000 at the option of the holder, either at specific dates or 1 to every 5 years, or if the firm takes a specified action, then it could be then that the holder decides to redeem that bond. There are international bond issues that we need to also talk about, like the Euro bond. The bond is issued by an international borrower and sold to investors in countries with currencies other than the currency that that borrower has, where the bond is denominated in. A foreign bond is issued to by a foreign corporation or government and is denominated in the investor's home currency and sold in that investor's home market. Two of those would be the Bulldog bond, that's foreign bond issued in Britain, and the Samurai bond, which is issued in Japan. There are certain valuation fundamentals that we need to look at. Valuation, that's the process that links that risk and return to determine our asset worthiness. There are key inputs to that: cash flows, timing, and risk and required return. So here's an example. Celia Sargent wishes to estimate the value of 3 assets: common stock in Michael Enterprises, an interest in oil well, and an original painting by a well-known artist. Her cash flow estimates are as follows. So her stock in Michael Enterprises expects to receive cash dividends of $300 per year indefinitely, starting in year 1. The oil well expects to receive cash flows of $2,000 after 1 year, $4,000 after 2 years, and $10,000 after 4 years, when the well will run dry. The original painting is expected to sell in 5 years for $85,000. So we have taken the first step in our valuation. So let's take a value and consider 2 scenarios. So scenario 1, our certainty. Major art galleries contracted to buy the painting for $85,000 after 5 years. So the contract's already been signed, the art gallery is well established, reliable. She views that asset as money in the bank and uses something close to the prevailing risk-free rate of 3% as the required return when calculating the painting's value today. In scenario two, this is high risk. So the values of original paintings by the artist have fluctuated widely over the past 10 years. So she expects to sell the painting for $85,000, but she realizes that the sale price could range between $30,000 and $140,000. So with that high uncertainty, there is a 15% required return that's appropriate. So these two estimates illustrate how the valuation process accounts for risk through that discount rate. So although adjusting for the discount rate has subjective element, analysts use historical data with forward-looking models to estimate the required return with as much precision as possible. So there's a basic valuation model to use. So the value of an asset is the present value of all the future cash flows it is expected to provide. So we have the value of the asset at time zero is equal to the cash flow expected in year T over 1 plus R, our required return or discount rate, to the T period, which is our time period. So by plugging things into that equation with the values of each asset, the Michael stock pays a perpetual stream of $300 dividends. That reduces that down, which then says the present value of a perpetuity equals the dividend payment divided by the required return. So she decides that 12% discount rate is appropriate for investment. So our estimate of the value of the enterprise stock is $300 divided by 0.12 or 2,500. So now she's going to value the well investment. She believes it's the most risky of all three. So she's going to use a 20% required return, and she's going to estimate the value to be 2,000. She's going to do this over the period of time that she's getting that money. So in the first year, she gets 2,000, 4,000 in 2 years, and 10,000 in 4 years. After that, when the well runs dry, with the same 20% required return for each of those. So the value of the well is 92.6698. Finally, she's going to value that painting by discounting the 85,000 in 5 years at 15%. So with that, the painting is worth 42,260.02 today. So regardless of the pattern of the asset's expected cash flows, she's using a basic valuation equation to determine the asset value. Bonds are long-term debt instruments used by businesses and governments to raise large sums of money, usually from a large group of lenders. A lot of them are corporate bonds. They pay interest semi-annually or every 6 months at a stated coupon rate. They have an initial maturity of 10 to 30 years and have par value, principal, or face value of $1,000 that the borrower has to repay at maturity. So for example, the Mills Company just issued that 6% coupon rate 10-year bond with $1,000 par value that pays interest annually. So investors who buy this bond receive the contractual right to two types of cash flows. One, there's a $60 annual interest 6% coupon times that $1,000 par value distributed at the end of each year. And two, the $1,000 par value at the end of the 10th year. So here's our bond values for annual coupons. Here's our equation to use up. M is going to be our par value in dollars. C is going to be our annual coupon rate, interest payment in dollars. N is our number of years to maturity. R is our annual required return on the bond. And we're trying to find what the value of the bond is at time zero. Here are our bond values for annual coupons. So Tim Sanchez wishes to determine the current value of the Mills Company bond. If the bond pays interest annually and the required annual return on the bond is 6% equal to its coupon rate, then we can calculate our bond's value using the equation that we just saw. So we have $60 divided by 0.06, which is the return rate, times 1 minus 1 over 1.06 to the 10th degree, because it's over a 10-year rate, plus 1,000 over 1 plus 0.06 to the 10th power. And we're going to find that our bond value is going to be $1,000. So here is how we do our discount. So we're going to discount 441.61 through years 1 through 9 or 10, sorry. And then in the 11th year, when we have to repay that, we're going to have it at 558.39. So that total for our bond is $1,000. We could use our calculator to help us figure this out as well. So you're going to see that you're going to do the second PY one for the year because it's annual. 10 is our N for our number of years. 6 is our interest rate. 60 is our payment. $1,000 is our future value. So what's our current value? Our present value. And that's going to be 1,000. The calculated bond value is equal to the par value, which is always going to be the case when the required return is equal to the coupon rate. We can also use Excel to show the same information by using the PV function here. So our bond values for semi-annual coupons. As a practical matter, most bonds make semi-annual rather than annual interest rates. So we can calculate the bond value by paying semi-annual interest. It requires 3 changes to the approach that we used so far. So we're going to convert the annual coupon payment C to a semi-annual. So we're going to do C divided by 2. We're going to recognize that the bond has N years to maturity. It will make 2N coupon payments. So because it's semi-annual, it'll make 2N semi-annual periods. And we're going to discount each payment by using the semi-annual required return calculated by dividing that required return by 2. So R divided by 2. So here is our new equation. And you'll see where it says 2N with the sigma sign. That's a total. So you're going to add up everything. That's just an easy way to indicate that if you haven't seen that before. So here is our equation for bond values for semi-annual coupons. So Mills Company bond pays interest semi-annually. Their required annual return is 6%. So we can find that our bond rate is also 1,000 here, even if it was paid semi-annually, because the required return equals the coupon rate. The bond's going to sell at par value. When the required return does not equal the coupon rate, the bond may sell above or below that par value. Here is the calculator use. Again, plugging 20 in 2 times a year instead of 1, 6 interest rate, 30 payment, 1,000 future value. Our present value is 1,000 as well. We could also use the spreadsheet here using the PV function. And again, everything is divided by 2 because there's 2 coupon payments a year. But there could be changes in bond price. So when the required return rises, the bond price is going to fall. And when the required return falls, the bond price is going to rise. So when we're looking at required returns and bond prices, we have to look to see if there's a discount or a premium. The discount is the amount by which the bond sells below its par value. So when that required return is greater than that coupon rate, the bond value will be less than its par value. If there's a premium, this is the amount that the bond is going to sell above that par value. So when the required return falls below that coupon rate, the bond value would be greater than par. So here's an example again with Mills Company paying their 6% coupon rate maturing in 10 years, assuming annual interest rates for simplicity. So initially we assumed that the return was 6%, so the bond's value was equal to par as 1,000. So what's going to happen if the bond's value is required it's going to be higher or lower than that coupon rate. So if we look at this table next, we're going to see that at 8% required return, the bond's going to sell at a discount with a value of 865.80. And if the required return is 4%, it's going to sell at a premium of 1162.22. You can use your calculator use here again. And then also spreadsheet as well. So this shows us 8 and 4% and the differences that come up with that. Again, the coupon rate is 6%. So when it has a required annual return of 8%, it will be selling less than its par value at 1,000. The bond value then would be 865.80. And then if it sells at a lower required annual return than what the coupon rate is, it's valued more at 1162.22. So here's that table that shows the bond value and those required return rates and the status that they are in. Here is the bond values and required returns based off of that information that we were just given there on the slope. With changes in bond price, we also have to look at the interest rate risk. So this is the chance that a bond's required return will change and cause a change in that bond's price. So other things being equal, the long-term bond prices move more when the rates change, whereas the short-term bond prices are less sensitive to those rate changes because those long-term bonds are associated with more interest rate risk. Other things being equal, higher coupon bonds have less interest rate risk exposure compared to those lower coupon bonds. And a bond with a lower required return has a greater interest rate risk compared with a bond that has a higher required return. So here is a graph that shows the interest rate risk and bond characteristics for those four specific bonds. So you can see how the coupon rate and the return rate, along with maturity time wise, you could see the difference of those to see where the change in bond prices is more influenced by that change in required return based on that coupon and required return rate. We can also look at the passage of time and bond prices. So if a bond trades at a premium and its required return remains constant, that bond's going to get closer to maturity and the price is going to fall. So it's eventually going to reach par value. If the bond's going to sell at a discount and the required return remains fixed, the time passes that bond price will eventually rise, reaching their par value before it matures. If it trades at par value, it's going to remain at that value until maturity, as long as that required return doesn't deviate from that coupon rate. So the next figure we're going to look at is the behavior of bonds calculated earlier for Mills Company. And we're going to see how the bonds value at both 8 and 4% approaches and ultimately equals the bonds value of 1,000 at maturity. So here is that depiction here, where we have the premium bond, where we have the discount bond and the par value. So everything at maturity at 0 is always going to be equal to that $1,000. So the 8 years to maturity, if we look at the discount bond, we can see that it's worth $885, whereas at the premium, it's $1135. If we look at 3 years, we notice that the premium bond has decreased down to $1055, and the discount bond has risen at $948. And then finally, everything meets again at the end of the 10 years. We could also look at yield to maturity. So this is that compound annual rate of return earned on a bond purchased, assuming that all payments arrive on time and the investor holds that bond to maturity. So mathematically, that YTM is a discount rate that equals the market price to the present value of the cash flow. So here's an example to find YTM, yield to maturity, on Mills Company. So the bond's currently selling for $929.76. It's got a coupon rate of 6%, 1,000 par value, pays interest annually, and it has 10 years to maturity. So we can find that YTM using the equation from 6.5a and solve for that discount rate of R. So we're going to plug all of that in. So initially, let's guess for the YTM and solve for the present value. So because the bond's current price is less than the par value, its YTM has to be greater than that coupon rate, remember? So let's make an initial guess and say 10%. So let's plug that in. So at 10%, is $929.76 equal to that 10% rate? So let's check it out. So the math is demonstrated down below, and we can see that at 10%, it's $754.22. So we know that it's not going to be 10%. So let's try 8%. So when we try 8%, we get $865.80. So it's still not 100% there. So that doesn't equal the $929.76. So we're going to try again. Let's try 7%. With 7%, that does give us the $929.76. So at the 7% discount rate, the present value of the bond's cash flow equals the current price. So right now, 7% is the bond's YTM. So the market's required annual rate of return for the Mills bond is 7%. We can use our calculator to figure this out, to figure out what the interest rate is. We could also use the Excel sheet. One way to solve for this is using the IRR function, the internal rate of return function. We're going to enter the bond's price as a negative number, subsequent coupon, principal payments as positive values, the price of the cash outflow that the investor has to receive. The IRR function finds that the discount rate at which the present value of cash inflows equals the present value of cash outflows. But that's exactly the definition of YTM, the discount rate where all of that is equal to. So the IRR function in Excel solves for the bond's YTM, but it also calculates the YTM per period. So in this example, we're looking at payments arriving annually. So each period is a year. So in Excel, we could always change the IRR to figure out what the YTM is per period as well. Another way to use an Excel is to use the rate function. It allows you to solve for a bond's yield to maturity using that. So that's what this looks like here. And the rate function returns that periodic rate of return that corresponds to the payment frequency. So you could always change this and use this equation too. So say it's, a quarterly. So the coupon payments per year would then change to 4, which would then adjust that bond yield. Now suppose that the Mills's bond makes semi-annual coupon payments. It still sells for the same price, so now we're receiving 20 semi-annual payment coupons of $30. That would be the 6% times 1,000 divided by 2, plus the $1,000 par value at maturity. So before using the rate function, we're going to use an equation, and we're going to substitute for R. So we're going to play with it, say 7%. We're going to try that again. We're going to find that 929.76 is not equal to 928.94. So we know that it's not 7%. The value is a little bit too low. So it's slightly higher than 7%. So again, you can keep doing trial and error, but you're going to find that the discount rate of 6.988% is the correct answer. And that's going to be within a cent of the bond's current price. You can use a calculator. Again, it's going to give you that same function there. And again, you can use Excel using that rate function. Coupon payments per year are now 2. A number of years to maturity stayed the same at 10. So that gives you the 6.988%. So in this chapter, we looked at equilibrium in the flow of funds between savers and borrowers using interest rate and required return. Most interest rates are nominal terms. That represents the rate at which the money grows over time, where the real interest rate represents the rate at which the purchasing power grows over time. The difference between the nominal and the real rate is the inflation rate. For risky assets, the nominal rate is the sum of the risk-free rate and a risk premium reflecting issuer and issue characteristics. And that risk-free rate is the real rate of interest plus an inflation premium. So for any class of similar risk bonds, the term structure of interest rates is the relation between the rate of return and the time to maturity. And the yield curves plot that relation on the graph and can be downward sloping or inverted, upward sloping or normal, or just flat. The expectations theory, the liquidity performance preference theory, the market segmentation theory offer different explanations on why the curve is shaped the way it is. The risk premiums for non-treasury debt issues result from default or credit risk and other features like maturity and exposure to interest rate risk. We looked at corporate bonds. They're long-term debt instruments that the company has to repay under clearly defined terms. Usually they're 10 to 30 years and have a par value of $1,000. The bond indenture enforced by a trustee states the conditions of all the bond issue. It contains standard debt provisions, restrictive covenants. It might include a sinking fund requirement or maybe even a security interest. The cost of a bond to an issuer depends on its maturity, its offering size, and the issuer risk, and on that risk-free rate. We looked at a bond issue that might include a conversion feature, a call feature, or stock purchase warrants. We looked at returns on bonds measured by the current yield, yield to maturity, or yield to call. We looked how bond pricing typically is reported along with their coupon, their maturity date, and their yield to maturity. We looked at bond ratings by independent agencies on how they risk and classify bonds. We looked at various types of traditional and contemporary bonds that are available and also talked about Euro bonds and foreign bonds that are established for those credit-worthy companies and governments to borrow against internationally. We looked at the key inputs to the valuation process that include cash flows, timing, risk, and the required return, and the value of how any asset is equal to the present value of all future cash flows it's expected to provide over that time period. We also looked at the value of a bond as the present value of its coupon payments plus the present value of its par value, and how the discount rate is used to determine bond value, which might differ from the coupon rate. If a bond can sell at a discount, at par, or at premium, depending on what the required return rate is equal to, greater than, or less than its coupon rate. We also looked at the chance that interest rates will change and thereby might alter that risk required return and the value. That's called interest rate risk. The shorter the amount of time until a bond's maturity, the higher its coupon rate, or the higher its required return, is the less responsive its market value is going to change to that required return. So the passage of time affects bond pricing as well. The price of a bond is going to approach its par value as the bond moves closer to maturity. And finally, we looked at yield to maturity and how that's the rate of return investors can earn if they buy a bond at a specific price and hold it until it matures. And that can be calculated using a calculator or using an Excel spreadsheet. So bonds that pay interest semi-annually are valued by using the same procedure, except that interest payments are 1/2 of the annual. The number of periods is twice the number of years to maturity, and the required return is 1/2 of the stated annual required return on similar bond risks. If you guys has any questions regarding this chapter and bonds, please let me know. We are at the end of week 2, so we will be getting into week 3 information here shortly. If you have any questions, let me know. Hop on to one of the Zooms that I have for office hours, or feel free to just send me an email if that's easier and you don't want to hop on. You don't even have to turn your camera on if you don't want to, but just know that I will be available for 30 minutes during those times that I've set up for office hours. Have a great day.